From a cash flow perspective, you made $10,700, but you only pay taxes on $443. That's the beauty and the magic of doing real estate. In this video, I'm gonna walk you through a basic example of how to file your taxes for a standard rental property. What's going on, guys? Mike, the CPA here. Thank you once again for joining me, and I just want to say thank you to all the new subscribers. The channel continues to grow day by day, regardless of what I do. So I really appreciate the support. And if you're brand new here, I make videos that cover finances, investing, and taxes. But certainly if you're interested in those subjects, then certainly hit the red subscribe button down below, hit the bell notification icon so you do not miss any of our future uploads. If you wouldn't mind, just drop a like on the video, and that's going to help this content, this information that I spend a lot of time producing, reach more people. So thank you so much, and let's get into the content. Like all of my tutorial videos, this video is not intended to be tax advice, so always consult with a CPA if you have questions, or an enrolled agent before filing your taxes if you need additional assistance. And this video is created, of course, for educational purposes. Let's just get into the example, and I'll kind of show you how this works if you're just thinking about renting out your home or just a standard residential property. When you decide you want to rent out a home, let's just say like a residential home in this example, Schedule E is the place you're going to go for that to report it on your personal tax return. And this is, of course, we're assuming that you do not have your property in a separate business like a corporation, an S corporation, or an LLC, or a partnership. This is just if you decide, hey, I have an extra house now, I want to rent it out. This is where you would report that information, that income, those expenses, on your personal taxes. And Schedule E, it's fairly straightforward. I'm not going to go too crazy into the details because I don't want to bore you guys to death, because tax is a very dry subject. But just know the first thing you would list, of course, is the address of your property right here. It's in the first part of the form right here where it's talking about part 1. It's asking you, did you make payments, or were you required to file forms 1099? A lot of people don't know this, so I always encourage people to check out the 1099 instructions to see if they are required to be issuing these forms to people. You are legally required to, at least from a tax perspective, to do so if you're paying somebody who's managing your rental, who's not incorporated, or who, let's say they're doing lawn care services or whatever it may be. If they're not incorporated, if you're giving them over $600 per year, you're probably going to have a 1099 filing requirement. So definitely check out the 1099 instructions, and I'll leave the links to those instructions down in the description section of this video, and along with a bunch of other links so you guys can check out a lot of the other tax videos I've produced on this channel. Let's talk about fair rental days real quick, because this is really important in terms of determining the deductibility of the expenses that go towards your rental property. If for whatever reason you don't have your property rented the entire year because you're using it personally, well, those days would not be counted as fair rental days. You're actually allowed to have up to 14 personal use days, okay? Personal use days, 14, got it? Before your income or before your expenses that you spend on your property start to lose some of their deductibility. Now, as a CPA, I see a lot of rentals. Most of the time, people have it rented out the entire year, or the majority of the year. So for the most part, those expenses are fully deductible. But that's just something to be mindful of, is that if you only rent this out for half the year, and the other half of the year you use the property personally, or you have it up for sale, well, then you can't deduct the full year's worth of expenses because you didn't rent it out for the full year. Does that make sense? Another thing to know about a fair rental day is that if you're renting the property, I've mentioned this in my other video, which I'll leave a link to below, is that if you're renting the property to like a friend or a family member, a relative, whoever, and you're not charging them fair market value rent, well, that technically is not a fair rental day until you are indeed charging them the proper amount of rent that any normal person would pay if they were to rent your property if they were not a member of your family. So those are just some basics that most people are completely unaware of when they begin renting a property, or starting to figure out, hey, how do taxes work on this? Let's just say you rent out a property for $18,000, and that's for the year. Okay, so you're basically collecting rents. Let's just say you put the property into service as of 1/1/2019 in this example. And so that's roughly $1,500 a month in rent, right? That's what we got, $1,500. Well, during the year, you have traditional expenses that would be associated with a rental property. You might have advertising expense. So we list $100 here. You might have cleaning and maintenance. You might have insurance. Well, you'll definitely have property insurance related expenses. You might have legal and professional fees. So maybe you paid a CPA or an accountant to help you do your taxes. Well, part of that accounting fee you can actually deduct on against your rental income, which is really nice. Helps further reduce the amount of tax you pay on this income, if any. Management fees is pretty common. A lot of people have a property manager. For a property manager, what's nice is they often will provide you a statement that lists all of their fees for the entire year and just provide that to you at year end. They might, depending upon the property manager you use, they might even give you a complete breakdown of like, okay, here's your total rents for the year, here's your expenses, here's what they were, etc. So sometimes having a property manager will do a lot of the accounting work for you, which is where I think the bulk of the complexity comes into play with rentals, is just keeping good records. If you keep good records, all of this is super easy. If you don't keep good records, if you're not organized, this is going to be very challenging for you. And if you take this to a CPA and your records are messy, they have to spend more time figuring it out. They're going to charge you more to do your tax return. So I'm going to show you in just a second a template that I've created that you can use to track your rental expenses and keep it as clean as possible throughout the year, so that if you were to do this yourself, you're going to make it easy on yourself. Or if you're going to provide your information to a CPA, an enrolled agent, or whoever, then you're going to make it easy on them, and they're not going to have to spend so much time and charge you so much in fees to do your taxes. So those are things to be mindful of. Your mortgage interest that you pay on your property, very standard. You should be able to see that amount. When you have a mortgage on your property, you get a tax form called a 1098. Tax form 1098. And that tax form is going to show your total mortgage interest you paid. Now, it typically comes from a bank. So whether it's Bank of America, Chase, whoever your lender is, that's who you're going to receive the 1098 from. And it's going to show that total amount of interest expense for the year. And often, if your payments are impounded so that your property taxes are included in there as well, well, then you're also going to be able to see your total amount of property taxes you pay on that rental throughout the year as well. So that makes it really nice. If you don't have those kind of expenses impounded, well, then you're going to have to separately calculate what those amounts are and just figure that out. You definitely might have some repairs, as no tenant is perfect, or things just break in general, right? Every year something seems to break down. Well, it might be an appliance, it might be, it just might be a damage to a door, who knows? Broken window, leaky faucet, whatever it may be. But make sure you're keeping track of all your repairs, your receipts for those. And as you're tracking your receipts, make sure you're writing on the receipt what it means. Like, what's that expense for? So like, is this a repair? Is this a management fee? Is this an accounting fee? Keep track of that, and you're going to make your life really simple. So as you can see, these expenses, they're pretty basic, right? You have advertising, you might have cleaning, repairs, and property insurance, property taxes, mortgage interest. I think where people get confused and hung up on rental real estate or just assets in general is when it comes to the concept of depreciation. That's where people really start to get scared about doing their own taxes. And it's not the simplest subject to explain, but I'll try to explain it just real briefly, and just so you have a general idea of how it works for rental real estate, at least for the building itself, the actual property. And so what I've done is, on an Excel file I've put together, and I've created a separate tab on this Excel file. Let me zoom in. Let me make sure you guys can see that. Okay. So with residential rental real estate, the amount of time is so depreciation in general. If you've never heard of the concept before, it's basically you get to expense the cost of an asset over an extended period of time based on tax law. And so with a home, if you go out and let's say you buy a $300,000 home, you can't just deduct $300,000. The IRS tax code will not allow you to do that. But you can expense it or depreciate that expense over, and for a property, it's 27 and a half years. 27 and a half years, but I think a better way to think about it is 330 months. And you're going to see why that's an easier way to think about it when you're trying to calculate this. So when you have a property, and let's just say the cost basis for the residential building is $280,000. Well, generally speaking, when somebody buys a rental property, and this is a very common mistake I see all the time when people are trying to do their own taxes on rentals, is they presume they can depreciate the entire cost of the property. You cannot. That is not correct. You can only depreciate the portion of the cost of that property that's related to the building itself, the home itself. The land you cannot depreciate, but you still have to record the land if you're doing this correctly. There's still a portion of it that's land. So in this example, you can see the cost basis on screen is $280,000. And this is just a general rule of thumb. I've seen this for a long time. If you wanted to get this really accurate, you'd look at your property tax statement and see what portion of your property is land versus building and all that. You know, what portion is the structure versus just the bare land, like your backyard or whatever. So those are things you would look at. But generally speaking, just general numbers here I'm throwing out at you is that 75% of the cost of your home, or 80% of the total cost, can be depreciated, which means that the rest is going to land. Okay, so the other asset you have is the land portion of that. So the building in this example is $280,000. We can depreciate that. So if I was thinking that this is 75% of the total cost, well, then that means the land would be, let me calculate this real quick for you guys. That means the total cost of this property would be $373,000. But we're only able to depreciate $280,000. Guys, follow me? And so the way this works is, and I wanted to show you the calculation so you could actually see how we got this number right here, this 9,757. So you can see the math behind the screen, because that's something your accountant, they're never going to show you it. They're just never going to show you that unless you figure this out for yourself. I mean, if you ask them, they might, but in general, they will not take you the time to teach you any of this stuff. And trust me, I know, because as a CPA, you're very limited on time, very limited. But with these videos, though, I can actually take time and share some of this knowledge and information with you guys to help you. And so so what you do, if we're going to place this in service as of January 1st of 2019, when you put a residential property into service, you do not get the first month you put it into service, you do not get a full month of depreciation. This is a tax concept. You would not know this unless you did what I do for a living. You would probably never figure this out. Or unless you did a lot of reading on the IRS website, or if you read the publication 946, which covers depreciation, then you might learn how this works. But other than that, most people will never know how this works. So in the first year, even though you've had this in service the entire year, you don't get to take a full year of depreciation. So you get to take 11 and a half months divided by 330. Okay, so let me bust out the calculator real quick. We're going to take 11 and a half months divided by 330 total months, because that's 227 and a half years. We get this number, this long number. We're going to multiply that now times the total cost of the building portion, not the land, but the building, of which we've determined to be $280,000. We're going to multiply it, and there's our total depreciation for the year, $9,757. That's how that's calculated, and that number is what goes here. When you're using tax software, the tax software is probably going to do this all for you. You just need to place the asset in service, and this is just using Maker Straight Line, or just a straight line depreciation method. There's multiple or various kinds of depreciation methods, and I'm simply using straight line, and that's pretty common for residential real estate, because you get a set amount. You basically get a set amount of depreciation every month for 27 and a half years, and that's how you get to expense the total cost of your property over that time period. And so for 27 and a half years, you have this thing called depreciation reducing your rental income, because it's an expense, right? So in this example, we had $18,000 in income. Once we add up all these expenses, that comes out to be $17,057. That means we have a net income of $943. So that's what our net income would be. But there's one more kick I threw in here just to show you guys the cool part about rental real estate is there's also a concept known as passive activity losses. Got that? Say it with me. Passive activity loss. For most people, renting out real estate, whether it's commercial, residential, whatever. Most people have a separate part. They have a day job. They have something else they do. They're basically they don't make, most people don't make their entire living through real estate. They're not considered a real estate professional. And there's that, we'll save that for another video of what real estate professional actually means. There's actually guidelines. Passive income, the 18,000, that's passive income, right? That's how the IRS looks at this. And these are passive expenses. So passive income can only offset, passive expenses can only offset passive income in general. Let's just pretend with me now for a second that this is year 2. So in year 1, we lost $500. That $500 loss, we did not get to deduct last year because we didn't have enough passive activity income to offset it. In year 2, though, we can use that now because we have more passive income. So that loss is not completely lost. We now get to use it in this example. Without the passive activity loss carryover, we'd have $943, right? In this example, we just have this carryover coming through of $500. So that's going to help us reduce our income even further. So our net taxable rental income in this example is $443, okay? Obviously, if we didn't have any prior year loss carryovers, this would be 0. And we would just have a net income of $943. The easiest way, guys, that I think, I won't say the easiest, but a very easy way to keep track of your taxes is this template I've put together for you. And I have a video on this. I've made this a few years back, but I think over 10,000 people across the country now are using this template. And I've gotten just such nice comments and feedback on this. But this is how this. It's a profit and loss summary. You can use this for any kind of business you have. I use this template to track whatever I make from this YouTube channel. I use this exact same template. I've been using it for years. It's simple. It works. And you can see if you're keeping track of your income every month, your expenses every month, this template will total all the amounts for you over here. And you're going to have very clean records. And check it out. It ties back to the amounts on the tax forms. If you look at this closely, it actually ties right back. So if you have, the point I'm trying to make here is if you have good bookkeeping, if you take the time and do this throughout the year, it's really easy. If you wait until the end of the year when you're busy and try to recreate all this and try to remember what happened through the year, it's really hard. So what I like to do is take time every month or every 1 or 2 months and update this. And that's what I would recommend doing. Every 1 or 2 months or every quarter, make sure you're updating this so that you're not going to get really far behind on your receipts, on your accounting for your rental property. And life is going to go so smoothly. Because then essentially what you're doing is you're taking these totals right here, see where my mouse is at? And you're just transferring them to the tax form. And most people don't realize this, but most people don't do this level of bookkeeping. And I don't even consider this extensive bookkeeping. But so for most people, they're paying their accountant to do this. And it's really expensive to do it that way. It's not wise. If you do this, it's much simpler. Now, maybe you don't have the time to do this and you want to pay the accountant. That's fine. But if you want to save some money, or if you want to try doing this yourself, that's how you do it. So if you compare those numbers to these, it's really straightforward. And you just transfer those totals to the form and you're done. Again, as you can see here, the net income here is $443 on the template because I've built this thing to handle rental properties right here. It comes out to be $443. Easy peasy because it's bookkeeping so important. And you guys can add, you can add rows if you want to add, other expenses or if different kinds of income in here. Generally though, only rental income should show up here, but you might have various other kinds of expenses that might not be listed here. So feel free to tweak it. That's what it's here for. You guys can use this to your benefit. It's completely free. I'm not going to try to charge you guys $5 for this. I think it's silly. So, but take it, use it, and if it helps you, great. And hopefully you can see that this isn't too challenging. The most complicated part of it is really the depreciation calculations. Hope this helps. I just wanted to walk you guys through this. The last thing I'll show you is that the way this all flows to your tax return. Let me show you how this all connects. You start on Schedule E, okay? After you fill out Schedule E, there is a Schedule E page 2. Schedule E page 2. And you can see that net income amount is $443 comes here. And that transfers from there to Schedule 1. And that from Schedule 1 goes to the main summary page of your taxes on line 7A. So the way this moves is it goes from Schedule E, the Schedule E page 2, to Schedule 1, and from Schedule 1 to the front page of the 1040. And that's how that flows on your tax return. That's how it all connects. These forms talk to each other. If you're using tax software, which I highly recommend, you won't have to worry about any of this because it's going to do it for you. But most people use software, but they don't understand what it does or what it means. So that's how this works. And I wanted to walk you guys through this. I get a lot of questions about real estate and taxes in general. Make sure you check out many of my other tax videos. I'll link them down below. And I look forward to reading your questions and comments down below as well. That's the best part of doing YouTube. There's also another form you'll want to familiarize yourself with, and that's the passive activity loss limitation form, Form 8582. And that's if you have losses from a rental property that you cannot deduct in the current year, those get carried over here. And so that, like that $500 I use in this example, just to show you an example of this, that's where that's coming from. It's from a previous tax year, that loss carried forward, and that $500 transferred to Schedule E, if you guys remember, on that tax form right here. That's where that $500 came from. That came from Form 8582. A lot of people, you might have heard that real estate is one of the best investments in the world. And for the most part, that's true. That's true, especially from a tax perspective. People are always bragging about how much money they make in real estate and they don't pay taxes. Well, what they mean is that they have this thing called depreciation. What I wanted to point out here is that, so you made $18,000, right? The advertising cost, the cleaning and maintenance, the insurance, the mortgage interest, the management fees, supplies, repairs, taxes, whatever. That is all real money that has come out of your pocket. That's real money that has left your pocket. Depreciation, you get that expense for tax purposes, but guess what? That did not come out of your pocket. You didn't have to pay $9,000 that year, or close to $10,000, because you've already paid for the home. You already have a mortgage on it, and your tenant's paying for the property through the rent, right? In a general sense. So you get this $10,000 deduction here in this example, roughly, and you're not paying. There's no additional cash leaving your pocket. So although it looks like you've only netted $943 at the end of the day, right? That looks like that's all you've made. But in reality, from a cash flow perspective, you've actually made $9,757 on top of that. So your cash flow is $10,700. That's how much real money you had come into your pocket, into your bank account. But you only pay taxes on the $943, right? Or less the $500 carryover, right? So $443. So you, from a cash flow perspective, you made $10,700, but you only pay taxes on $443. That's the beauty and the magic of doing real estate. I could go on and on, but I think I'm going to wrap the video up here, guys. So I really hope you like it. If you did, make sure you drop a like, subscribe for our future videos, and definitely leave a comment or your questions. I really do hope you find this helpful. Obviously, I put a lot of time into creating these examples and, making these templates available for you, just so that you can arm yourself with financial education that you're not probably ever going to get anywhere else, or it's going to be hard to find anyone like this to teach you this for free. And so I really hope you get something out of this. Until then, have a wonderful week, live life uncaged, and I'll see you in the next video. Peace.